Well, welcome everyone to our lease accounting training today on the topic of 842. It's a guidance we've heard a lot about. It's been pushed back a lot, and now it's finally here. So we want to do this refresher course to kind of update your understanding of lease accounting. If this is your first time hearing it, hopefully we'll provide you some information that you need. And if this is not your first time listening to it, hopefully this training kind of triggers some of the memory you've had about, oh yeah, I need to make sure to disclose this or disclose that so that you're ready. And we'll talk a little bit about effective dates in a little bit here today too. You will be receiving CPE for this course, 1.5 credits for CPE today. After the course is over, a survey will be sent out to participants based on our tally and our records on who's participating today. And it will be sent out after the event today to gain access to certificate. A survey will need to be completed before that certificate will be provided. So if you have any questions, you can kind of email me and ask me that, and my contact information will be available in the last slide later today. So the objective, as I mentioned today, is to learn about the new ASC 842 guidance and the disclosures that are related to ASC 42 and kind of how to apply for it. Hopefully you saw a link to the Excel document. There is a template that we'll be using as part of our training for some of the exercises and as well as guidance that will hopefully help you gain an understanding of what their journal entries looks like with the new guidance. And we'll talk about that. An example will be shared for a case study today, and we'll walk through that template together in our presentation today. This presentation is being recorded and played to you via this recording. This is to allow me so I can respond to you in the Q&A as we go through this presentation today. There will be a live Q&A as well at the end of this presentation, so kind of watch out for that. So let's talk about the effective dates. This new guidance is already in effect for public companies, and we have some examples we'll share about the disclosures. But for private companies, it is effective beginning after December 15th, 2021. So your fiscal year is beginning after 2021. So imagine, well, for most entities, that'll be January of your calendar year end, January of 2022. And so we'll, it's coming up. And so hopefully this gives you information to prepare for it. So here's the old standard. Old standard with leases talks about operating versus capital. You know, if it doesn't meet the criteria that's defining capital, then it's operating. It's kind of talking about the benefit and risk of ownership transfer. Capital lease criteria, as you are aware, you know, those 4 criterions that talks about ownership transfer tests. If it passes the title at the end of the lease, it's a capital lease. If there's a bargain purchase option, it's a capital lease. Or if it's a 75% of estimated economic life test. So if your lease term is longer than 75% of the estimated economic life of the assets, it's a capital lease. Or if the present value of your payments on the lease represents 90% of the fair value of the asset which you're leasing, then that's also a capital lease. So that's kind of the old standard. The new standard changes that a little bit, and it changes some of the terms a little bit. There are some elements in the capital lease criteria that still applies for the new standard, and we'll talk about that a little bit more today as well. The old criteria also does not provide information for financial statement users on the commitments and how these contracts are funded. So this is mainly one of the main information or main reason why there's this new standard. Users for financial statement basically are saying, well, you have this commitment. It kind of feels like a liability because you're committed, regardless of what you do with your company, that you have to pay these amounts for this estimated amount in the future. So as a result, with this critic, the new standard came out and saying, well, this kind of feels more like a liability. And then, you know, critics of the guidance is saying, well, even though there's a liability, we don't have the assets on the books. We don't have the benefit of it. So how is this a liability? And so that is why this new standard came about, to provide more information and footnotes as well as to record all leases that are long-term, meaning longer than 12 months, to be a liability on the book. So the new standard really takes away capital or operating lease terminology to finance versus operating. All such leases will require you to capitalize an assets on the books called right of use assets, as well as the lease liability. For the lesser, so you still have the categories of sales type, direct financing, operating, lease terminology, and all of the initial recording will be the same, regardless of whether it's finance versus operating leases. And we'll go through an example of that as well to explain. So here we get to our first practical expedient. There are different practical expedients you could utilize in terms of transition or your accounting for it. The first one is that if you have a lease that has a lease term of 12 months or less, you don't have to apply this guidance at all. So what does that mean? Meaning that if you have a lease of, for example, leasing a printer, right? And your lease for that printer is 11 months, and you don't have a bargain purchase option or renewal terms at the end of the lease, then you don't need to capitalize or present value that to record the right of use assets or the liability on the books. This is a lot of people think, hey, this guidance doesn't apply because my lease is shorter than 12 months, so I don't need to worry about it. You do though, if you apply this. Remember that this is a practical expedient, so you are still required to disclose that you're using this for your lease guidance in your footnotes of the financials. There is a question that arose as people were implementing these lease guidance, and initially there weren't much information or guidance behind it, and that's the realm of what if you have a lease term, essentially, where you're leasing a venue or a product or an asset that is technically 3 years, but you're only using the economic life for a short amount of it. So for example, if you have a parking lot, right, and you're leasing the parking lot space only Monday through Friday for 13 months, right? Is that, even though my economic value of that 5 days times 52 weeks is less than 365 days, or not 52 weeks, sorry, 5 days times 13 months, does it qualify me for this short-term lease? Well, the ASC glossary for leases mentions that contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment for a period of time in exchange for consideration. So the explanation here is that if you have a non-consecutive period lease, such as parking lot or stadium, and you calculate the actual control of when you can actually use that asset, that tangible asset, and it's less than 12 months or a year of 365 or 367 days, however you define that 12 months, then you can actually use this practical expedient, and therefore do not need to apply ASC 842 to those leases. Other lease types are also evergreen leases. If you're a month-to-month, you do not need to apply it because essentially your commitment is actually less than 12 months. So this is welcoming news to, I know, some of my clients that were in the situation where they're only leasing like 2 or 3 weeks for an event for the next 3 years, 2 or 3 weeks of the year. So this is a welcoming practical expedient that applies to them, as they don't need to then consider whether those should be capitalized and how you will capitalize those. Other exceptions that was ASC also introduced that that this ASC 842 does not apply is the lease of intangible assets. So if it's more for a patent, you're leasing patent, that won't apply here. Exploration of use of minerals, oils, natural gas, similar resources, biological assets like timber, sometimes I guess zoo animals, sometimes people rent zoo animals there, those won't apply. Inventory and construction in progress won't apply, neither with assets under construction. So those would not apply to ASC 842. So then we'll get to the nuts and bolts of it. You could kind of look at leases as in 3 steps. Number 1 is there a lease? Does your agreement qualify for a lease? Number 2, what type of lease is this? And then 3rd is determining the consideration related to the lease. So that after you go through these steps, then you can kind of know how you should apply the accounting for it. So first step, is there a lease? As I mentioned earlier, if you have already downloaded that Excel template that we'll be using today, there is a decision tree for this section under the first tab, is there a lease? And we'll kind of talk about that a little bit, and so you can follow along there if you like. There are a few questions to kind of help define if you have a lease or not. First is there an identified asset? And as I mentioned earlier, intangible assets like patents or rights or licensing do not apply. Here it has to be physically distinct. So it has to be a tangible asset. Examples are things that have serial numbers, locations, something you can identify. If the agreement does not specify, then it is not considered a lease. It may not be considered a lease. One of the things to watch out for are substantive substitution rights. Sometimes you might have a contract that is kind of vague on it, and basically it provides the lessor the right to substitute an alternative to you. Example of those are like warm sites. Sometimes warm sites are provided for tech companies where they're saying, hey, we need a backup location in case our location goes down, so we can kind of spin up our operations quickly. So those are locations that may have equipment in place and chairs and connections already ready in case something happens. Now, a lot of those clauses mentions that you have the right to use it in case something occurs, but it also provides lessor the right to substitute an alternative location for those warm sites. And if you do have some of those substantive substitution rights for the lessor to kind of at their discretion to substitute, then a lease is mostly not present, and instead it will be more of a service contract. And then the second thing, also supplier, which is the lessor, would benefit economically from the exercise of its rights, meaning that, hey, if they can substitute those rights for a cheaper location, for example, and it's not specifically identified, those would also qualify as a qualifier to not be a lease here as well. Examples of those is some examples here about warehouse space. If you have a warehouse space that's not specifically identified, they're going to provide warehousing for you. Visible. I know there's an entity here, Visible, that's they do fulfillment for companies, right? Some of those fulfillment responsibilities, they're just providing a space, and they don't specify what rack you can utilize, and so then those won't be specifically a lease here, and so other guidance will apply. WeWork is an example of those. You have the right to use their space, but you have the right to use multiple different spaces in different locations all throughout the nation. So that wouldn't be a lease either. We already talked about lease for intangible assets. So second part is, once you think you have a lease, you can say yes to that first question. And the second question is, does the customer have the right to obtain substantially all of the economic benefit from the use of the assets throughout the period of use? So meaning here is that does the customer have control, right? To have substantial control over the assets throughout this period. And so if you can say yes, then you can move on to a third question. So the third is, does the customer or the supplier have the right to direct how and for what purpose the identified asset is used throughout the period of use? So now the second question, going back to the second question, is you have the right to obtain substantial of the economic benefit, meaning that has that economic benefit for you. Now the question is, can you direct that asset, that asset that you have leased for your purposes without interference from the lessor? Example of lease that would not qualify is if there's a lease for a building and machinery for manufacturing, but the landlord is only allowed to operate the machinery and determines when it can operate, as long as it meets the demand of lessee. So if you have the right to use it, but you can't control it, you can't direct how it's being used, then it most likely would not have a lease in this situation. If you say no to the third one, there are some additional questions to consider that may still allow you to qualify. So 3A and 3B are introduced. So 3A is, does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? If no, then the following also has to be answered as well, is that the customer designed the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use. So, so let's say, I mean, we'll have a practice question on this as well in a little bit, but let's say if you have a manufacturing equipment that you're leasing, the lessor says, well, you can only use it for these days, and I have to have one of my employees kind of help you, assist you in operating. That could still be a lease, as long as they can't randomly change those days on you later on and say, hey, you know, Monday and Friday doesn't work. I'm actually now going to do Saturdays and Sundays instead, through Saturday through Wednesday instead of Monday through Friday. If the lessor can change that on you, then you also have to look at 3B here, right? Is the assets designed in a way that predetermines how and for what purpose the asset, are you involved in the designing of the assets in a way that predetermines how and for what purpose the assets will be used throughout the period of use? And if you can say that yes, then you may still be able to record as a lease. If you say no there, then this is not considered lease, and ASC 842 will not apply. So with that, let's go through our first example polling question to kind of practice that. Is this an example of a lease? So Lessee and Company is leasing a machine from its production of toilet paper from lessor and friends for the next 3 years. Lessee can use the machines only from Monday through Friday at the lessee's location, and lessor do not have the ability to change the instructions on how lessee can use the machine. So I'm going to stop the video here and then let you respond to that polling question. So hopefully you were able to answer that polling question. And the answer is that, yes, this is a lease. Hopefully you answered yes, and that's because it is a tangible asset. So, and also lessee have control of the asset without lessor's ability to change the limitations of its use. So that would qualify for a lease there. So then the second question of our process is, what type of lease is this? Again, there's a separate tab within the Excel document that you should have received. If not, there's a link that will provide in a chat box, so you can click there to download it. You know, how do you determine what type of lease is it? Is it a financing or is it an operating lease? So the questions are there are 5 of them. 4 of them are actually very similar to how we have done it before with the old standard. Number 1, does the lease transfer ownership at the end of the lease term? So meaning that they're transferred. Second, is there a bargain purchase option, right? Is there an option to purchase? And it's reasonable certain that the lessee is going to exercise it. Third, is this the lease term for a major part of the remaining economic life of the underlying asset? Is the lease term for a major part of the economic life? And the defined threshold is at 75%, what we talked about earlier. And fourth here, is there the fair value, is the present value of your lease payment substantially all of the fair value of the underlying assets, equal to 90%. Now, the fifth question that ASC 842 introduced is this: is the underlying asset of such a special nature that it is expected to have no alternative use to the lessor at the end of the lease term? Meaning that the lessor at the end of its life is probably going to scrap it anyways because they have no use for it. Then if it meets any of those criteria, any of those 5 criteria that I talked about, then it will be automatically be considered a finance lease. And if it doesn't meet any of those 5, then it will be operating. So we're going to try a poll question here. Same circumstance that we talked about in our previous example, renting a machine to use. Now here's some additional facts. The lease cost is $10,000 per month. The comparable fair value of the machine is $1 million, and the remaining economic life is 10 years. So, kind of let you do the polling question. Give you some time here to respond. Again, this is going to be a lease cost. So if you think about, hopefully you're able to respond. If you think about the math here, going through the 3-year life of the 3 years of the lease term compared to 10 years, it probably doesn't match. Or if you're going through the 4 points here, it wouldn't be majority of its economic life. And if you look at the present value, even before you present value it, you can see that you're paying about $360,000 of it. So even if you don't present value it, it's already not going to meet that 90% threshold to be qualified a finance lease. Lease term is only about 2 years because, 5 days plus 52 weeks plus 3 years divided by 365 compared to that 10 years. And there's no transfer rights or no bargain purchase options that we have mentioned. So as a result, this would be considered an operating lease. And then the last point I failed to mention here is that there's no special machines that I'm aware of that makes toilet paper. So I am that is why that 5th criteria won't apply either. So now that we know from that example that this is a lease, that it is a operating lease, then how do we account for this? As we mentioned earlier, operating versus financing lease would be recorded the same way initially. Initial entries would be the same. So one of the key things that we need to figure out then is to determine the right of use asset value. And the formula for that is to figure out the present value of the future lease payments, plus any initial direct costs, plus any prepaid lease, minus any lease incentives received, will be the initial right of use assets. So what is included then to determine the present value of future lease payments? The contracts, one thing to kind of make sure that you need to do is to read through the contract to make sure that you're identifying the components of the lease. Contracts may have a non-lease components, and then also lease components. And then there's a third section that we'll talk about is and also may have a non-component. So there's three things. Again, there's a lease component, non-lease component, and then a non-component, and we'll talk about that. So steps to determine the non-lease component is whether it has the you have to separate, determine the contract separate the three components, and then determine the contract consideration, and then allocate the contract consideration to lease and non-lease components, and then apply the appropriate rates of discounts to determine what the present value of the future payments are. So first is that lease and versus non-lease component. Components that lease components are components that are integral to the right of use, the underlying asset. So if you have a lease, if you have a component within there that where the lessee can benefit from the right to use underlying assets on its own, so you may be making payments that help benefit the right to use that assets, that is probably part of the lease components. The second is that the right to use is not dependent on nor highly integrated with other right of use. So if it's if there's a component of your payment that is not dependent on highly graded with other rights to use, then most likely will be components of the lease. So examples of that components will be, right to use the building. So you may have different payments, maybe variable or fixed, and those are going to be and they're all specified for the right to use the building or land or equipment. Then those would be part of the lease components here. Non-lease components are distinct elements of a contract not related to securing the use of lease. So examples of those would be operating the building, right? So you may be paying CAM, or you may be paying repairs and maintenance costs or cleaning fees for the maintenance of the building. Those would be non-lease components. Training or security or supplies or management, those all will be non-lease components that you have to define or identify and distinguish between those in the lease components. And then after that, after you have determined those components, then you will want to determine the contract's consideration. Now, ASC 42 does mention in here that three different types of considerations that you may be paying. You may be paying a fixed payment, meaning that it's fixed for a certain amount, month to month. It defines how much those are. Those would be fixed payments. You may be paying variable payments that depend on an index or a rate. Or you may be paying variable payments that are not based on a rate or an index. So those three different categories, the only items that you will consider for your contract payment, present valuing back to determine present value future payments will only be the first two. So your fixed payments, as well as your variable payments that depend on an index or a rate. So an example would be variable payments is saying, hey, I'm going to pay a variable payment over, and have it be increasing every year based on CPI, right? Or based on a defined rate. Those would be considered rent consideration, lease considerations. Anything outside of that will not be included. And we'll have an example of that. So here's an example. So lessor leases a bulldozer to lessee to be used in lessee's construction operations for 3 years. Lessor also agrees to maintain each piece of equipment throughout the lease term. The total consideration contract is $600,000 payable in $200,000 annual installments. So the question here is then, what are the components? And then also, what is the total consideration that you'll be considering here? So hopefully your answer was this, that the lease components will be the equipment, the non-lease components will be the maintenance, and then that the total consideration is the $600,000. Here's another question for you. Again, similar situation. Lessor leases a bulldozer. Lessor also agrees to maintain each piece of the equipment throughout the lease term. Total consideration contract is $375,000, payable in 125 annual installments, with a variable payment for the maintenance aspects determinable in the future. So, what is the total consideration here? All right. Hopefully, this is your answer. With this situation, the lessor and lessee, same situation. The real change here is that instead of $600,000 fixed, the total consideration is now $375,000 fixed, with the remaining maybe in a variable payment. So the components will be the same. Lease will be the equipment, and non-lease with the maintenance. And the total consideration to consider is only the fixed portion, which is $375,000. And why wouldn't the variable payment apply here? Is because the variable payment is not pegged to any index or any sort of metrics. So after we have identified the components as well as the consideration, then we need to talk about lease versus how do we allocate the consideration to lease versus non-lease components. So factors to consider is that you need to kind of see if you can find a relative standalone price of each deliverables, and then apply it proratably to the respective areas. So we're going to go through an example of that a little bit here. There is a practical expedient that I want to mention, though, is that if you are applying this practical expedient for old leases during the transition time, it does allow the lessors to aggregate non-lease components to lease if the following is met. That the timing and pattern are transferred for the non-lease component and the associated lease components are the same, and if the standalone lease component would be classified as operating lease if accounted for separately. So there is a practical expedient for lessors, so that you could simplify it. Another aspect is that if the non-lease is predominant, then you could just kind of group it with as a service contract, and similar to ASC 606 will apply there. If an aggregate, if the predominant after you aggregate it is mostly leased, then you can just apply mostly predominantly to the ASC 842 in the lease guidance. So a little practical expedient that's helpful for the lessors. So here's another poll question then. So we're going to practice, and I won't stop this one at this time. We'll just kind of work through it together. The lessor leases a bulldozer to lessee to be used in lessee's construction operations for 3 years. So similar fact pattern as what we have been talking about before. Total consideration is $600,000, and we already identified that it's fixed. That's $600,000. So we know that there's a lease component, we know there's a non-lease component, and we know the total is $600,000. So how should we allocate this? So I'm going to give you some time to look through this. We do know the standalone price of those by doing our market research to be $560,000 for built bulldozer, and then also $140,000 for a maintenance cost, for a total of $700,000. And so there's the total market percentage of what $700,000 will represent. So the answer, you'll just use that 80/20 to apply to that $600,000 to fix to determine the value for each of those components. And then after using that, after knowing this, then you'll only apply the lease guidance on that $480,000. There is a practical expedient now this time for the lessees with lease and non-lease components. You could look at your leases and then have separate accounting policies by asset class so that you can include both the lease and non-lease components as a single component and account for it as lease. Similar to the lessor, you aggregate it, and if it's predominantly non-lease, you can use ASC 606 for it. If it's predominantly leased, then you can use ASC 842 for it, but you have to elect this policy by accounting class. So here is the poll question here again. Similar fact pattern. Yep, similar fact pattern here, but this time you're going to be using the practical expedient for combining leases. So in this situation, because the lease is predominant here, which is 80% here, you could elect to say, hey, all construction equipment here for this asset class, I'm going to be accounting for it all the $600,000 as my as lease expense. So before, we also mentioned a little bit about non-lease components. Remember I mentioned that there's a lease component, there's a non-lease component, and then there's a section that is just non-components. ASC defines non-components as any activity that does not transfer a separate good or service. So an example of that will be real estate taxes or insurance costs, right? Insuring the property itself. Sometimes lessors will still pass those on to the lessee. And so these will be non-components. So we'll kind of understand about how these will be accounted for. One thing to kind of remind you as we go through this explanation for non-components is that if there are variable considerations for costs that are not contract components, they're excluded from total consideration and will be just recorded as incurred. So really, if what we're saying here is that if there's a non-component, meaning those real estate taxes or insurance are variable, you can disregard it and just record it as you incur it, and then that will be the treatment of it. You don't have to determine if you need to be including it as part of your right of use calculation. However, if they are fixed, though, it does say that they need to be included in the lease consideration and allocated with the lease. So we're going to practice a non-component here. Lessor and lessee enter into a 5-year lease of a building. The contract designates that a lessee is required to pay costs for the asset, including real estate taxes and insurance. The real estate taxes would be owed to the lessor regardless of whether it leased a building and who the lessee is. So meaning that it's owed to the lessor, right? But the lessee is basically, through this lease contract agreement, agreeing to pay for it. And the annual lease payments are fixed at $10,000 per year, while the annual real estate taxes and insurance premium will vary and be billed to lessee each year. So how would the payments for real estate taxes be related? I'm going to give you a little bit of time here to report on the polling question. One thing to remember is that the fixed and variable that we described just now, hopefully this is your answer then, is that, with the, how would the payments for real estate taxes be treated? because the real estate taxes and premiums are variable, remember that variable, those are just going to be recorded as incurred because that variable payments is not dependent on an index or a rate. And so therefore, they will just be excluded from lease components. So here's another question, same facts as before. Annual lease payments are now fixed at $13,000 per year. No additional payments for real estate taxes and insurance, but the $13,000 is itemized as follow. So $13,000 includes the real estate taxes and insurance. And so this situation now, we changed it from the variable to fixed now. So how would the payments for real estate taxes and insurance be treated? Hopefully you're able to answer the question. And the answer is that this amount will be considered, that non-component will be considered as part of the lease component because the amount is fixed. So therefore that $13,000 that we kind of talked about, $13,000 total of 5 years will be considered part of the lease component and allocated appropriately and be included as part of the right of use. So now we know that the lease, what type of lease it is. We know the components, we know the total amount that's paid. Then we need to figure out how to discount it and present value the total future payments. And to do that, we need to determine the appropriate rate. The rate that ASC 842 mentions is the implicit rate. There's lots of words here. I'm going to use this diagram instead. Basically, what implicit rate is, they're saying that the rate will be to get that to your future payments, present value of lease payments, and also the value of assets after the lease to equal the fair value of the assets right now, less any investment tax credit retained, and also the initial direct cost by the lessor. So meaning that you will have to come up with the rate to make sure that whatever it costs the lessor right now for their assets right now, whatever its value, will be the total amount of the present value of all your lease payments and what the value is after that. Obviously, you can see that this definition is a little bit hard to come up with, because what you won't have as you enter into a lease necessarily is what that fair value of, right? What is that fair value of that assets from your lessor? And then how are you going to define the fair value of the assets after the lease as well? And so this definition makes it really hard to come up with what the rate is, because the lessor most likely will not be willing to provide you of that information. So even though the guidance wants you to use the implicit rate, most companies I've seen use this alternative, which is the incremental borrowing rate, which is the rate of interest that a lessee would have to pay to borrow on a collateralized basis. And so if you have that information handy, I would suggest then you'll present value using that rate, whatever your collateralized borrowing rate is. And if you don't have one, you may be able to kind of identify through maybe similar companies what that rate would be to come up with that rate for. But if you really don't feel comfortable with inferring what your rate would be, there is another practical expedient for private companies, so meaning companies that are not traded or in public markets, that allows the lessee to use a risk-free rate. So you can, so if you have a 5-year lease and you don't want to use the implicit rate or the alternative borrowing rate, you could go to T-bills and determine what the T-bill rate is for a 5-year treasury, and then use that rate to determine what your discounted cash flow would be. The downside with this, though, is that it probably would create a higher right of use assets as well as your lease a liability initially, but it does simplify it significantly. So going back to kind of our formula of determining right of use assets, there are these other 2 items to consider. Besides the present value of future lease payments, there's also any initial direct costs. So things that you pay for commissions or legal fees, or paying, maybe you're paying for existing tenants to move out. That could all be included as part of the right of use assets value and be capitalized for that. And then the other part is lease incentives. Sometimes you may be provided by the lessor to provide certain lease incentives. These lease incentives will reduce the right of use assets that you may have. So, for example, they may say, hey, for this lease, I'm going to also provide you with furniture. Well, you will need to then value what that furniture would be, record that as an asset on your books, but it will also decrease the amount of right of use assets on your books there. The tricky part that sometimes you have to also consider are any lease improvements. Are they truly incentives or not? And you really have to look at the fact pattern to determine that. So for example, here, if there's a lessee leasehold improvement where the lessor is paying for it, but the improvement, the lessor is paying for it, but the improvement is they're adding more to the building, but at the end of the lease, it's going to be the lessor's assets. Then that really is in fixed assets for the lessor and not truly an incentive. Now, if there's an improvement that represents a lessee's asset that you're going to take possession of it, then that will be considered a lease incentive. Now, conversely, if the lessee is paying for it, but it's the lessor's property, right? So they have a building that's mostly done, and the lessee is saying, I'm going to pay for the rest of it to kind of to complete it to a spot where it's a tenant can actually occupy it, but it can't be until that point. Then that's really a prepaid rent that you're prepaying for that, because it's going to be the lessor's property. Or in situations where there's a lessee's paying for it, but it's not fully reimbursed by the lessor, but it's the lessor's asset, then the difference would be a lease payment. So if you pay for it, but it's not going to reimburse or not fully reimburse, then that would be a lease payment as well. Okay, now we're going to talk about lease terms a little bit here, and then we'll have a practical example that we'll use the spreadsheet for. When we consider lease term, it's important to remember that we're not only looking at the initial term of the lease, you also have to consider the renewal terms of the lease and termination options. If there is a right for you to renew that, and you're most likely reasonably going to exercise it, then most likely you'll need to include those renewable terms into your total lease. A good example of that would be, if there's a space that you're going to be leasing, it's a prominent space that most people know of, and you're most likely not going to be moving to another space, or there's not likely another space for you to use. for your operations, then you probably need to consider how what is reasonably certain that you're going to exercise those options. If it's going to be 2 more years and 4 more years, that those 4 more years will need to be included in your initial term of your contract. Options and certain options are certain to be exercised is included in determining the term of the lease. So now we understand that. Let's kind of switch gears to that Excel document, and we'll go through it. But before we go through it, let's talk about the scenario recap. We have a very simple scenario here. A lessee company, remember, is leasing a machine for toilet paper making, and from Lessor and Friends, they're going to be paying $10,000 per month for the lease costs. We already know, based on the comparable fair value of machine is, $1 million, and we know remaining economic life is 10 years. And for this scenario, we're going to use a risk-free rate. And so in this scenario, from what we talked about, we already knew it was going to be a lease, that it is a operating lease because there were no, that didn't meet any of the 5 criteria that we talked about. And it's going to be $10,000 a month over 3 years. So with that, I'm going to exit out of this presentation mode here and then pull up our document here. So here's the template. So in this situation, we're going to use the operating lease tab. We're going to put $10,000 over 3 years, which is in this case, I'm going to do monthly, so it's going to be 36 months. We knew there was not going to be any initial direct costs or prepaid lease. And we're going to use a discounted or a risk-free rate because we're a private company. And let's assume that the risk-free rate is 2.5%. Now we've got to do it. The rate has to be similar to how we interpreted the periods above, which we're interpreting as monthly. So we're going to divide that 2.5% by 12 here. And then lease term is going to be 36 months, right? So what this does is then it'll calculate out what our right of use assets. Right of use assets, initially, our initial entry will be the 346,000 right of use assets on the books, and then the lease liability of 346,000. This is determined based on the total payments that we have established above, with that 2.5% annual rate divided by 12 to get to the present right of use assets. Subsequently, after our initial entry, our subsequent entry will be this. As we pay that $10,000, we'll pay it as lease expense. The lease liability will be amortized over using the interest rate method. We'll decrease the right of use assets, and then total cash out will be recorded there as well. So so all the interest piece component will be kind of expense. So the difference between the $10,000 monthly payment and the $9,278.16, it's essentially going to be recorded then as part of the amount of interest flowing through there. So you can see that up here in period 1, when the interest component is $708.21, it's going to be throwing through income statements at $10,000. Cash flow is also going to be $10,000 there as well, flowing through on our cash flow. And then the right of use assets will continue to decrease until there really isn't anything anymore by period 36. Now let's talk about what will happen if this is a finance lease, right? Let's say we use the same, how is this different? Assuming that there is a bargain purchase option. So let's put that on here again. Uh, 2.5%. If we're getting to add the equal sign here, lease term 36 months. You can see that the initial is still the same, 346,483. It's the same as what we have recorded in the first place. Now the difference is that our entries, now we're going to break out the interest component piece as an actual interest expense. So we're going to put interest expense piece of $721 for that period, which is the interest rate that we had multiplied by the 346. We have amortization expense of the right of use assets. And then the lease liability will be decreasing as we actually pay the cash amounts of it. So as you can see here, the same $10,000 is going to, there's actually going to be more expense in finance lease using the finance lease method because we are actually calculating all of the interest expense and the amortization expense independently. And whereas in operating expense, what this does is the interest component or the amortization component is really just kind of flowing through as one line, as a lease expense line. The amortization, you can see the formula here, is really just the difference when you're amortizing a right of use, the difference between the $10,000 of expense and the interest method, whereas these are looking at each independently. The right of use assets using that over and straight lining that over the life of 36 months. And then the right of use, and then the interest piece using the interest rate. And so that's kind of a big difference between the operating lease and the finance lease, is how it will flow through, how the differences will flow through the P&L that way. So with that, we're going to go back to this slide. I do have a table here that will that shows this and kind of how the difference is. What you're going to end up is that on the operating lease side, you'll have the same $10,000 expense on a monthly basis. But then for the finance lease, you're going to have actually more expenses initially flowing through P&L and then less expense subsequently. Similar to what you would do when you are actually borrowing money and then going out and getting a loan to borrow the money to buy the equipment. So, and I'm going to stop here so we can, before we move on, so we can see if there are any additional questions before we talk about input, practical expedience. Well, thanks for bearing with me. And we have this last section about practical expedience for transition, as well as disclosures that you will need to include now for your footnotes to your financial statements. So as you can kind of imagine, this is pretty daunting for a lot of companies, especially how widespread this is across different industries. So they have issued practical expedience to help with some of the transitions. The first one, when you are adopting this, you could either use modified retrospective approach or full retrospective approach for adoption. So, if you have experienced accounting changes before, usually they require the full retrospective, which you have to recast your comparative financials between last year to this year, and then you kind of show both years as if this was in adoption all along. Well, this modified retrospective approach is basically allowing you to only look at your contracts that are currently outstanding at the year of implementation. So for 2021, come January, when you look at 2021 and you say, okay, as of December 31st, 2021, so when you adopted January 2022, December 31st, January or December 31st, 2021, what leases are outstanding. And so for those leases, I'm going to recalculate what the right of use assets would be at this time for those contracts, and then record that on my balance sheet, and the offset will be equity. So that's kind of the modified retrospective approach. So far, I've seen most people use the modified retrospective approach because it does simplify it and create less work for recasting. Other practical expedients, there is this package of 3 where you have to use all 3 if you were to do so. If you can select any one of them. It's the lease classifications grandfathered. So if you already have capital versus operating before, instead of financing versus operating, you could use those classifications and just grandfather those in, and then switch those over to finance versus operating. You don't need to reassess old leases. Number 2 here is to reevaluation of embedded leases. Sometimes you may have a service contract where you have an asset that you're leasing as well. So for example, if you are, you're leasing internet speed, and you're also you're using internet service provider, and you're also leasing some of the equipment that contains embedded lease in there. And so you would need to, basically this practical expedient saying, I've always used it as lease. I could always treat it as what it was before without reevaluating any embedded leases, and treat that as a service or outsourcing contract. Number 3 is you do not have to reassess initial direct costs. So if you had paid commissions or legal fees and those initial direct costs, you don't have to go back and say, well, what is truly indirect? And so you can just kind of ignore those that were paid before, and simplify the transition here. Again, you do have to use all 3. Another practical expedient for transition is the, let's see here, I did skip one, huh? Let's see here, we're here. Is that the hindsight rule. You can elect this rule, which must be applied consistently to all leases. Basically is to use hindsight to determine your lease term. So if you had, when you're looking at renewal options, how long is my term, or how long do I think I will have? Although you may think when you're, 2 years ago when you entered lease, you may have not thought that you'll renew. You don't have to go back and then determine and then use the 2 years instead of looking at what you have now. Now that 2 years have passed and you have exercised the renewal option, you can then use the renew option activity subsequent event as your hindsight to determine lease terms, and also assessing impairment of right of use assets as well. The other part is that another transitional practical expedient is to not separate between leases and non-lease. We touched on this a little bit earlier before. You can look at what's the predominant component. You can lessees, you can elect it by class to determine what the predominant is, and then use the predominant for your practice. Lessor is the same thing, only if the timing and pattern of the agreements are the same, and also the standalone lease components would be classified as operating. And then another practical expedient that we already talked about, this is a practical expedient, not just that ASC 842 doesn't apply, is that lessees are exempt from applying arrangements for lease terms that are 12 months or less. And we already talked and do not have bargain purchase option or renewal terms that are reasonably certain or for exercise. And we already talked about how if you have non-consecutive leases, just kind of reminder, you are using the actual control, the periods of where you actually have control to utilize that. There's also lots of disclosures that you need to add. I know typical clients have helped do the footnote disclosures for added probably 2 or 3 pages of disclosures to the financial statements as a result of ASC 842. So let's talk about it. So there's the qualitative disclosure, which is similar to what was in the past. You have to disclose the nature of your lease, which, you know, ASC 840 had that too. You have to disclose the information about leases that have not yet commenced that create significant rights and obligations of the lease. So that's a little bit new as well. So leases that have not yet commenced that you need to disclose in there. And then any significant assumptions that were used. So for example, the present value of future contracts or future payments, you have to disclose the discount rate related to that, the method of how you allocated consideration between lease and non-lease components, and contract containing and any contracts that kind of contain maybe embedded leases and how you determine that will also need to be disclosed qualitatively in the financials. Quantitative wise, on your face of the financials, you'll probably have a right of use assets line separately on your asset section, and then lease liability on the liability section. And then you will probably need to break that out between right of use for operating versus right of use for financing. Here, you also need to separate what your finance lease costs. So you'll need to disclose that between interest and your lease expense, your lease liability expense. Remember that from our exercise that we did in the Excel spreadsheet, those are kind of presented in 2 places, interest expense and lease expense. And then for operating lease, you'll need to disclose that in operating lease cost. Your short-term lease can't disclose the total cost of that as well. Variable lease considerations that you pay, you'll need to disclose that separately from your fixed, and any sublease incomes, you need to disclose that fully as well in the tabular format. Well, it doesn't have to be tabular format, but that's probably the easiest way to do it. Net gain or loss recognized from the sale and lease back transactions, if you have that. This bullet point about segregating between operating and finance lease, this part would probably takes, I would say, the most time in terms of calculation, because you do have to calculate not only the cash paid for amounts included or the supplemental non-cash, but mainly this weighted average. You have to, if you have lots of leases, you have to kind of calculate what the weighted average of remaining lease term would be, or the weighted average of discount rate, so that I can kind of disclose that. Now I have examples of that from Walmart here in a little bit. You will have to also disclose the maturity analysis. This is the similar table that you have done in the past, where you can disclose the cash flow payments for the next 5 years and beyond. So similar disclosures there, but this time you'll also need to disclose the amount of the lease liability that will be expanded or that will be expensed and released there. And then lease transactions also obviously with related parties. You also need to disclose all the practical expedients that we discussed earlier. Which of the practical expedients you have utilized to determine the transition. So here's an example of Walmart. This is the adoption language, basically saying, hey, they have adopted the new lease guidance and have decided to use the modified retrospective approach, and then elected the certain practical expedients that they're going to do for this lease guidance. And then they disclose the impact for the total assets and the increase in liabilities. And then they also disclosed its impact to retained earnings of $0.3 billion net of tax. They also talk about right of use, record based on discounted future minimum lease payments over a term of life. And then they mentioned that they didn't use the implicit rate, so then they used the incremental borrowing rate, so for the present value. And then let's see here. They also disclosed the practical expedient that they used for not applying ASC 842 on terms that are 12 months or less. So here's some of the quantitative disclosures, well, as well as the qualitative one. Here talks further up here, talks about the practical expedient to not separate lease from non-lease components for all underlying assets here, which there's a variable expense. So for leases in which lease and non-lease components have been combined, variable lease expense includes expense such as common area maintenance, utilities, and repairs and maintenance. And then here, the quantitative side, we talked about, you have to disclose the operating lease costs, $636 million, the finance lease costs broken out between interest and amortization, the variable lease costs. Further down, they also disclose the cash paid for amounts included in lease obligations, the assets obtained in exchange for the non-cash flow items, so assets exchanged for operating lease obligations, or assets exchanged for finance lease obligations. So that's the non-cash side of things. I have seen this two parts, the assets obtained in exchange and assets obtained in exchange for finance. I've seen some people, disclose that in the cash flow statement. That's perfectly fine. And then that's a supplemental to the cash flow. And then here's the weighted average that they calculate, these four numbers. I'll say these four numbers sometimes give me the biggest headaches as far as the calculation, particularly if there's a company that has lots of different leases. This is the maturity schedule, for between operating and finance. So they'll disclose the cash flow and discounted payments, and then the imputed interest related to it to get to the net lease obligations. So with that, I'm going to open up for questions. But before I do that, here's just some links to some guidances out there that may be helpful for you. Lease Crunch and Lease Query. They're both software that's out there that can help you if you do have large scales of leases and is wondering more of an automated approach for it. So you can take a look at their software and then see which one fits best for you. But they have provided great guidance out there. Okay, with that, I'm going to stop our presentation here and then open it up for questions that you may have.